Hey, everybody. Welcome to the morning market briefing. It's Friday, August 14th, 2026. Hicks, how we doing on the sound? Looks like we're good to go. Ben's out today, so just Tom and I. We're going to have a fun call today with a little light on the notes, but we're going to fill some time.
Yeah, Ben being out, usually he does all the prep work for the call. Andrew and I do little of that. If Ben's not here, then TK does it. But little to my knowledge, I walk around the corner, ask TK where the notes are. Also out today.
Also out. Yeah, I did not realize that young Thomas and Ben were on vacation together, but apparently they are. So
Yeah.
we got a 30-year auction that went off yesterday. Pretty weak.
Man, I mean, the expectation was that it was going to be bad, and it was bad. We just continue to see the real world data decouple from the bond market. And typically, I would say the smart money is in bonds. I've used that aggressively over my career, but
Is it now?
I just don't feel that that's the case right now. But the draft or the auction went off at a 5.216, which is a 4 basis point tail, which is a lot of tail for a 30-year bond auction, because once you get up into that kind of duration, that's significant difference in price. And that was below the when issued. So the idea was they were going to try and get it off more expensive than that. And the way the auctions work is all the bidders come in, there's a when issued price, and then they bid how much of the bonds they want to buy and at what price. And then they basically, anyone who's above it, they'll fill it there. And then anyone who's on it, they'll fill it. And until they get to the point where the entire issue is auctioned off.
It's almost a Dutch auction style.
Yeah. So the idea is that almost everyone who bid was either on the screws or below it, and so the average issue price was lower than the anticipated rate. So that's how that works. But otherwise, the stats were pretty normal. It's not like there were fewer people. The bid to cover was normal. The amount of indirects, so think foreign buying, was about 67%. So that's pretty normal and on average for the 30-year over the last handful of auctions. So those weren't outrageous. It's just that no one wanted to buy it at that price. They thought that was too cheap. Too expensive, which I just can't jibe with. And we'll get retail sales. I mean, some people would say we already got it, and I've already seen the data. But I think that we're just going to, at a certain point, something's going to break. The stock market and the bond market are completely decoupled. We continue to rise on stocks. The idea that inflation is ramping out of control and reality continues to decouple, and the bond market doesn't seem really know what to do. And I think that's, I mean, it's fair. We're entering a new regime. We're entering a point where we don't just look to the Fed all the time. And so people have to make their decisions. And a lot of people aren't putting a lot of thought into their decisions because they're just looking at the TV, and the TV says inflation's spiraling out of control and rates are going to continue to go higher. And so everyone's betting that direction. But
I think a lot of what Besant said last week in his tweet that we covered on here, a lot of it rings true for the actual investors. I mean, he was quick to chastise the journos who were posing as economic analysts for not being able to read the tea leaves themselves and do any of their own analysis. Seems like the confusion of Warsh's new path is dampening demand, if nothing else, for these instruments.
Yeah, it's just
people are just like, I don't really know what to do because no one's telling me exactly what they're going to do, so I'm going to sit this one out.
Yeah, and there's a fair amount of brain drain that's happened in this industry because, I mean, you squeezed out all the desks. Everybody, no one could make money trading bonds, myself included. I ended up on this side of the business because transactional business on bonds went to zero, and it got even worse all the way through 22. I was looking at a bond we bought that matured with my young protege Ryan, and the total return on that bond over a 5-year period was 1.63% annualized, which is the yield we bought it, which seems insane to me now. I mean, I think now I'm like, God,
that was probably juicy then.
Was that a good buy? And if you look at that on a tax-free equivalent yield over treasuries, that was 1,000% return over a comparable treasury at that purchase date.
Yep.
So it was 600 times, the 3-year treasury. And then with the tax equivalent part, 1,000 times the return, because you were getting roughly 18 basis points for treasury. And now, 3-year treasury right now sits at 417.
That's crazy.
And if you were to buy a muni, a tax-free bond on a 3 years, like, you'd be really pushing it to get good, clean stuff at under 3.5%, which would be, call it 80% of treasuries. Like, that would be a good buy because your tax equivalent yield would be somewhere in like the 5.20 range. So you'd be getting a spread on a tax equivalent basis, but not on a real basis. And at that time, you were getting hundreds of percentages on a real basis, and then clearly 1,000 on the tax equivalent.
Crazy.
So the world has changed, and the yield environment has changed quite a bit in the last 5 years. And so I think that there's just been so many pushed out. The oldest, most tenured people who were in the business stayed in the business because they had established businesses and could continue to be, but there were no new hires in bond world. And you start to get in that point where no one was hired to trade bonds between, 2019 and now. Suddenly, all of the youngest people are in their 30s or 40s, and there are no young dinosaurs in the bond world. And so I think people are confused, and they're now suddenly scrambling to hire talent in the fixed income space, but no one has any knowledge of how to trade these.
Yeah.
It's just become the Wild West a little bit.
Yeah, there's just such a vacuum there, and with a new regime at the Fed, a lack of creative thinking on the purchase side, it leads you in a spot where I would argue it creates good opportunities for us. Not that we're loading up on 30-year treasuries, so to speak, but there's certainly been
we certainly added a lot there.
Yeah, there's certainly been extensions that we wouldn't have expected to be here at the beginning of the year.
I mean, we didn't buy treasuries. I didn't buy a treasury for the first time until 2019 when Jay Powell raised interest rates the first time, arguably his first interest rate mistake. Yeah, his policy mistake. But that was the first time I ever bought a treasury because there had been absolutely no value in them for a decade prior to that. And then, then we went into a period where we bought almost exclusively treasuries. And now it's like we're kind of going back that way because the cleanest bonds are the most cheap right now. Treasuries and mortgages, which is la-la land. And treasuries are cheaper, we talked about it yesterday, than Greek debt, which is
insane,
absolutely bonkers. And so we're just spiraling out of control. That the pendulum is swinging way too far to one direction, and it's an opportunity. And not only that, but it's a great time to be trimming a lot of these stocks that have done really well. Some of them for reasons that are sort of unexplainable, other than people are just hyped right now about the stock market and turn around and lock in 5% returns for a long period of time. But you start to think, am I wrong here? And it doesn't really matter if I am or not, because every new bond is a new income stream for a long period of time. But it's certainly, the numbers don't make sense. And I guess we can jump into retail sales now. But
yeah, so retail sales looking for a month-over-month number of 0.1%. Last reading was 0.2%. How are we looking?
We are looking much lower than that. I said it right before the call, right as Hicks was counting us down. I said retail sales is about to tank. You watch, and
it's not exactly what he said.
Yeah, I used some more colorful language, but obviously I'm a consummate professional,
Family show,
as everyone
Family
knows.
Show.
We came in on the month over month at negative 0.6%. X auto negative 0.3%. X auto and gas negative 0.2%. And then we also had last month revised down by 10 basis points. So the data continues to go our way. Now, are bonds rallying with great enthusiasm? No, they're not. In fact, the long end is selling off, which makes no sense.
No sense at all.
The short end is buying up because guess what? The hikes aren't coming, folks. You heard it here first many months ago. But as of just a few minutes ago, we've now ticked down.
So let me get this straight, Tom. I want to parse data that we've collected over the last couple of weeks. Are you suggesting that non-existent and falling inflation plus a weaker than expected employment picture plus weaker than expected retail sales numbers is not a recipe for a rate hike?
Correct. That is correct. And the market still seems to.
Yeah. What are the current odds on the hike?
So to walk us back 2 weeks ago, the expectation was that Kevin Walsh was wrong and that we needed to hike rates at least twice this year. We're now sitting at 30% chance for September and only an 82% chance of one hike for this calendar year, which
that
will
30%
continue
number was
to
at
erode.
100% 2 weeks ago, wasn't it? Or pretty close?
I mean, just earlier this week, it was over 100. And then we got CPI and PPI, and it ticked down to right at 100, and now it's under. But a couple weeks ago, when everyone was writing the hit pieces on Kevin Walsh saying he was wrong and he should have hiked rates and he had absolutely no credibility, well, now all of the data is going his direction.
The lack of credibility if Walsh had done a hike in the last Fed meeting and then this data had come out would have been, I would argue, for people that are incredibly critical of the Fed chair and have been for the entirety of this show. We've only had a few weeks with this particular Fed chair. If he had hiked then, given our viewpoint, and not that we're the whole market, but given our viewpoint, and then we got the data that has come in, frankly, in line with where we thought the data would come in, it would have been almost impossible for him to regain trust from us.
We're down to 27%.
It's falling.
It's cooking. It's absolutely going to zero. Watch it. Yeah, I mean, the thing is, the argument was that he had shown his complete lack of independence.
Yeah.
And the irony is that
you're not independent because you didn't do what we all wanted you to do.
Yeah. In fact, he showed an incredible backbone in the face of, I mean, it's not like Elizabeth Warren was out there screaming at him. It was every single major financial news publication.
It is strange that like you can both criticize someone for a lack of independence while simultaneously crying about how we don't even know what he's doing.
Yeah.
Like, say what you want about like we've all been around unruly children. What makes them tough is you don't know what they're about to do.
Yeah, or drunk guys.
Like
you know,
definitely independent.
He could do anything here. Yeah, it's like he's independent of critical thinking or thought. Yeah, I mean, we've all been there. Yeah, yeah. So now we're down to 77% and dropping on the full year. So, you know, the haters and losers, of which there are many. And sometimes it creeps in. I mean, I said it right before the numbers came out that it feels like you're wrong. I mean, the 30-year now is at a 5.23. I mean, we're ticking away. Those people are already down on their.
That's crazy.
I mean, it's just, what are we doing here, folks? But, you know, now the front end, the 2-year Treasury, which was close to a 4.30 at the beginning of the week, is now a 4.11. And I'll tell you, we bought a lot of 2- and 3-year Treasuries this week because it's the most no-brainer idea in the world. Is like, hey, this thing is way oversold. You know, we've already bought bonds on the long end. Those continue to run away. Let's buy in the fat belly of the curve, you know, 2s, 3s, 5s, treasuries, mortgages, you know, some choice corporates. And it's all coming up for the boys now, even though it should be coming up significantly stronger after this retail sales number because I would say it's a more hardy piece of data. I mean, the jobs number was the first one. We don't rely a lot on that, but it was very negative. And since we've been overstated by a huge margin, it was probably even more negative than reported. And we got revisions down. CPI came in cold. PPI came in cold.
Yeah, the jobs data, we decry the lack of accuracy on it often, but there is at least a consistent trend in which you can basically lop off 80 to 85,000 jobs every single month that they report. That's a long-term average.
That's the real real number.
So although we don't think the data is particularly accurate, we're pretty comfortable that, you know, insert number here, let's take 80,000 off it.
Yeah. The standard deviation is 80,000 and it's never to the upside.
No.
Yeah. So, I mean, it should be a good day for short bonds. I don't know why it's not a huge day for long bonds.
Inflation's going to be coming roaring back. So we got new tariffs coming out, 100% tariff on unmanned drones. Just another effort to decouple from China, it seems.
Yeah, that seems to be the big piece is that it really is another supply side push. We've talked about it every single day on this call, but we can create more jobs and be more effective if we make our own drones, especially if arguably our number one enemy, certainly on the Mount Rushmore of current enemies of the United States, States, if we're making our own drones. Plus, you know, we can do things better and faster, stronger if we put our minds to it. That's the American way. So we got to make these sick drones.
Yeah.
Get Andrew popping.
Yeah.
You know, get Palmer Lucky making the coolest, weirdest new stuff.
Yeah.
And people forget he has his own separate Game Boy company, not publicly traded also, but where he makes it's basically a Game Boy with its own games that he makes.
Yeah.
But it's like,
what a hobby.
You know, it's handheld. It has little games on it. The guy gets it.
He's a real man. Locally, we're getting a new data center here in Marietta, off Powers Ferry Road near Delk Road, I think. Interesting. If you kept an eye on the protests, you would say this is surely being shot down. Former mayoral candidate Sam Foster, very vocal. He's riding his bike around town, telling people watch out for the data center. Some wild spin zones on that he's offered up on Facebook and other places. But if you've been driving around town, you'd say, okay, yeah, we're definitely not getting this data center. People are very strongly opposed. Past 5-2.
Yeah, and we talked about it a couple weeks ago, where it was like, oh, the government is really thinking this back, or rolling this back, and really thinking about this. That was never the case. We said that on the call. That thing was going to go forward, especially given the people involved in it, particularly the power they have locally. And Marietta is as good old boys as a major American city suburb can be.
Yep.
We know it. We see it every day.
Every day.
These are the people we
as a
rub
reminder, we
elbows
do
with.
have a mayor named Thunder.
Yeah, people forget. Shout out Thunder Tumlin.
Thunder, I think he's in his 6th term as a mayor. Wrote a rule saying you can't serve more than 4 terms. And guess what? He's in number 6.
Yeah.
Or whatever it is.
Yeah, Thunder has an age inappropriate haircut as well.
Yes.
He got that haircut in 1976, and he's
still
keeping it rolling.
Yeah. Like if he got the Beatles haircut.
Yeah.
And still has it.
I mean, all-time mayor name. Also, shout out former Roswell Mayor Pug Mabry and former Smyrna Mayor Max Bacon. People forget the North.
We get it.
The North Atlanta suburbs have a nice history of ridiculous mayor names.
Want to talk about Bessent here within the content. I think we need to have a Scott Bessent tweet of the week every week. We do have one. So Robert Reich was born in 1946. That makes him technically very old. He's 80. He is a professor at Cal Berkeley. He was the former head of, I think, the Department of Labor under Clinton. He was a member of Obama's Economic Transition Advisory Board.
Professional whiner.
Big time whiner. And yet in 2008, Time magazine named him one of the 10 most effective cabinet members in history. He posted a video on YouTube earlier this week that looks, if you clipped videos together, most of it was other people talking, and he kind of made a montage. And if you pictured an 80-year-old doing that, it looks exactly like you would think. Like he somehow took what was at some point high-quality footage of the McDonald's CEO speaking, for instance, and made it grainy.
Yeah.
And made it look like it was from the 80s, even though it was from a few weeks ago. And he decided, there's 2 things that I really like about Scott Bessent's response, but he decided to go after Bessent, and he posted the video and said, Trump Treasury Secretary Scott Bessent said this week the K-shaped economy, the widening economic gap between the rich and the poor is, quote, dead. And then he explains why he thinks that's not true, and then posts this like 3.5-minute video. I love the content of what Bessent replies with, which we'll get to in a moment, but I especially love that he notably did not tag Treasury Secretary Scott Bessent in the tweet. He just named him. So I really like the idea that Bessent's sitting there just looking up his own press.
Yeah, he's looking for subtweets.
Who's posting about me? What's going on? I famously, at least within these walls, had an interaction with Hugh Freeze, the former Ole Miss and Auburn head coach, in the same context, in which I tweeted something about him and he DM'd me. And I'm like, so this guy's just laying around looking up his own name. But Bessent looks up his name, finds this, and offers this. McDonald's problem is called Burger King. Professor, no wonder Bill Clinton fired you. UC Berkeley should too if this is what passes for, quote, research.
Man. How we talked about on here, Burger King suddenly rising from the dead. Verbal meme.
Flame broiled, man.
The Undertaker meme.
Yeah.
Burger King, 8% increases in same-store sales, which is massive. And
McDonald's has a Burger King problem.
Yeah. I mean, Starbucks might have a Burger King problem, too, because they've basically gone fast food as well. It's interesting that, Bessent's just out there.
The knives are out at all times.
He's just scalping folks for no reason. Yeah.
The knives are out at all times. So we'll end it on that note. Hope you guys have a great weekend. We will be back on Monday. Talk to you soon.